Preferred stock, also called preferred shares, preference shares, or simply preferreds, is a component of share capital that may have any combination of features not possessed by common stock, including properties of both and equities of both an equity and a debt instrument, and is generally considered a hybrid instrument. Preferred stocks are senior, i.e., higher ranking to common stock, but subordinate to bonds in terms of claim or rights to their share of the assets of the company, given that such assets are payable to the returnee stock bond, and may have priority over common stock bond, and may have priority over common stock ordinary share. Payment of dividends and upon liquidation. Terms of the preferred stock are described in the issuing company's articles of association or articles of incorporation. Like bonds, preferred stocks are rated by major credit rating agencies. Their ratings are generally lower than those of bonds because preferred dividends do not carry the same guarantees as interest payments from bonds, and because preferred stockholders' claims are junior to those of all creditors. Preferred equity has characteristics similar to preferred stock, but the term is typically used for investments in real estate or other private investments where the common stock is not publicly traded, so private equity has no public credit rating. In general, preferred stock has preference in dividend payments. The preference does not assure the payment of dividends, but the company must pay the stated dividends on preferred stock before or at the same time as any dividends on common stock. Preferred stock can be cumulative or non-cumulative. A cumulative preferred requires that if a company fails to pay a dividend or pays less than the stated rate, it must make up for it at a later time in order to ever pay common stock dividends again. Dividends accumulate with each past dividend period, which may be quarterly, semi-annually, or annually. When a dividend is not paid in time, it has passed. All past dividends on a cumulative stock make up a dividend in arrears. A stock without this feature is known as a non-cumulative or straight preferred stock. Any dividends past are lost if not declared. Preferred shares, like other legal arrangements, may specify nearly any right conceivable. Preferred shares in the U.S. normally carry a call provision, enabling the issuing corporation to repurchase the share at its usually limited discretion. Preferred stocks offer a company an alternative form of financing, for example, through pension-led funding. In some cases, a company can defer dividends by going into arrears with little penalty or risk to its credit rating. However, such action could have a negative impact on the company meeting the terms of its financing contract. With traditional debt, payments are required. A missed payment would put the company in default. Occasionally, companies use preferred shares as means of preventing hostile takeovers, creating preferred shares with a poison pill or forced exchange or conversion features that is exercised upon a change in control. Some corporations contain provisions in their charters authorizing the issuance of preferred stock whose terms and conditions may be determined by the board of directors when issued. These blank checks are often used as a takeover defense. They may be assigned very high liquidation value, which must be redeemed in the event of a change of control, or may have great super voting powers. When a corporation goes bankrupt, there may be enough money to repay holders of preferred issues known as senior, but not enough money for junior issue. Therefore, when preferred shares are first issued, their governing document may contain protective provisions preventing the issuance of new preferred shares with a senior claim. Individual series of preferred shares may have a senior pari passu, equal, or junior relationship with other series issued by the same corporation. Preferred shares are more common in private or pre-public companies, where it is useful to distinguish between the control of and the economic interest in the company. Government regulations and the rules of stock exchanges may either encourage or discourage the issuance of publicly traded preferred shares. In many countries, banks are encouraged to issue preferred stock as a source of Tier 1 capital. A company may issue several classes of preferred stock. A company raising venture capital or other funding may undergo several rounds of financing, with each round receiving separate rights and having a separate class of preferred stock. Typically, Company founders and employees receive common stock, while venture capital investors receive preferred shares, often with a liquidation preference. The preferred shares are typically converted to common shares with the completion of an initial public offering or acquisition. An additional advantage of issuing preferred shares to investors but common shares to employees is the ability to retain a lower 409 valuation for common shares and thus a lower strike price for incentive stock option. This allows employees to receive more gains on their stock. In the United States, there are two types of preferred stocks: straight preferreds and convertible preferred. Straight preferreds are issued in perpetuity, although some are subject to call by the issuer under certain conditions and pay a stipulated dividend rate to the holder. There are income tax advantages generally available to corporations investing in preferred stocks in the United States. See dividends received deduction. But for individuals, a straight preferred stock, a hybrid between a bond and a stock, bears some disadvantages of each type of securities without enjoying the advantages of either. Like a bond, a straight preferred does not participate in future earnings and dividend growth of the company or growth in the price of the common stock. However, a bond has greater security than the preferred and has a maturity date at which the principal is to be repaid. Like the common, the preferred has less security protection than the bond. However, the potential increase in the market price of the common and its dividends paid from future growth of the company is lacking for the preferred. One advantage of the preferred to its issuer is that the preferred receives better equity credit at rating agencies than straight debt, since it is usually perpetual. Also, certain types of preferred stock qualify as Tier 1 capital. This allows financial institutions to satisfy regulatory requirements without diluting common shareholders. Through preferred stock, financial institutions are able to gain leverage while receiving Tier 1 equity credit. If an investor paid par $100 today for a typical straight preferred, such an investment would give a current yield of just over 6%. If, in a few years, 10-year treasuries were to yield more than 13% to maturity, as they did in 1981, these preferreds would yield at least 13%, since the rate of dividend is fixed. This would reduce their market price to $46, a 54% loss. Long time. Advantages of straight preferreds may include higher yields and tax advantages. They yield about 2% more than 10-year treasuries, rank ahead of common stock in case of bankruptcy, and dividends are taxable at a maximum rate of 15% rather than at ordinary income rates, as with bond interest. Preferred shares represent a significant portion of Canadian capital markets, with over $11.2 billion in new preferred shares issued in 2016. Many Canadian issuers are financial organizations that may count capital raised in the preferred share market as Tier 1 capital, provided that the shares issued are perpetual. Another class of issuer includes split share corporations. Investors in Canadian preferred shares are generally those who wish to hold fixed income investments in a taxable portfolio. Preferential tax treatment of dividend income as opposed to interest income may, in many cases, result in a greater after-tax return than might be achieved with bonds. Preferred shares are often used by private corporations to achieve Canadian tax objectives. For instance, the use of preferred shares can allow a business to accomplish an estate freezing by transferring common shares in exchange for fixed value preferred shares. Business owners can allow future gains in the value of the business to accrue to others, such as a discretionary trust. The rights of holders of preference shares in Germany are usually rather similar to those of ordinary shares, except for some dividend preference and no voting right in many topics of shareholders' meeting. Industry stock indices usually do not consider preferred stock in determining the daily trading volume of a company's stock. For example, they do not qualify the company for a listing due to a low trading volume in common stock. Perpetual, non-cumulative preference shares may be included as Tier 1 capital. Perpetual cumulative preferred shares are upper tier 2 capital. Dated preferred shares, normally having an original maturity of at least 5 years, may be included in lower tier 2 capital. In the United States, the issuance of publicly listed preferred stock is generally limited to financial institutions, REITs, and public utilities. Because in the U.S., dividends on preferred stock are not tax deductible at the corporate level, in contrast to interest expense, the effective cost of capital raised by preferred stock is significantly greater than issuing the equivalent amount of debt at the same interest rate. This has led to the development of TRUPS, debt instruments with the same properties as preferred stock. With the passage of the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010, TRUPS will be phased out as a vehicle for raising Tier 1 capital by bank holding companies. Outstanding TRUPS issues will be phased out completely by 2015. The size of the preferred stock market in the United States has been estimated as $100 billion as of early 2008, compared to $9 trillion for equity. Thank you for watching. Don't forget to please like and subscribe. If you have a topic you would like to suggest, leave a comment.